The ringgit would continue to be market determined, and a flexible exchange rate will help us adjust to changing global economic and financial developments. And this will also cushion the domestic economy from adverse global market conditions. So as you can see from the chart, our ringgit movement has been broadly in line with the movements of other regional economies. And more importantly, what we are seeing is that the onshore trading volume, the onshore FX trading volume in our market continues to be healthy, and the volatility in our domestic onshore market has been somewhat, not very far from what the historical volatility rate is. So, if I'm not mistaken, the daily volatility rate in our FX market is about 4%. So, so for us, the focus is to make sure that there are orderly financial market conditions, and we do have a wide array of policy tools to ensure that is the case. And and these policy tools would be deployed to make sure that there is no excessive fluctuations in the exchange rate that could be detrimental to the intermediation process and our economic recovery. So that would be the focus of our attention. A flexible exchange rate is what would be good for the economy. So with respect to the exchange rate, we have consistently emphasized that a flexible exchange rate is the most appropriate policy choice for our circumstances. And as what I had elaborated in the Bernama interview, a flexible exchange rate buffers the economy from adverse effects arising from economic shocks, and it also preserves Malaysia's competitiveness under challenging global conditions. So pegging the ringgit will not be in the best interest of Malaysia. It will have substantial risk and trade-off. For example, we would need to mirror the monetary policy of the country we are pegged against. So, for example, if the Fed were to raise its policy rate by 2%, we would have to follow suit to maintain the peg. And we would lose our monetary policy independence in this case. And Malaysians, in this case, would have to bear the higher borrowing costs, even though the economy is weaker than the US. We would also have to resort to capital controls. And all this would be necessary to ward off speculative pressure to the ringgit. We have to acknowledge that the key factor that attributed to our ability to successfully peg the ringgit in 1998 was the capital controls that was introduced then, which came at a cost. So maintaining a peg is a very costly policy because it will also take up a sizable amount of our reserves, especially during stress conditions. And this ultimately would weaken our external resilience. So applying a peg would have detrimental impact to investor sentiment, affecting not only FDI coming into Malaysia, but it would also likely exacerbate capital outflows from Malaysia. So while, again, Bank Negara, we do not target any level of exchange rate, we are in the market to ensure that there are no excessive volatility in the exchange rate and the conditions in the financial markets continue to be orderly.